Joining us now is independent investment expert and Switzer regular Roger Montgomery with his tips on investing in online companies. So which stocks are good, which ones are bad, and are there any that are just downright ugly? Welcome, Roger. Good to have you on the program.
Nice to be back.
Now, online listed companies, there is sometimes some nervousness with investors because you can't always walk into the building, see the four walls and the roof and physically hold on to the product.
Yeah, there's a legacy, I think, from a demographic of investors that probably isn't as applicable in terms of getting the best return on your money. Most people like to touch things. In fact, it was interesting, Gerry Harvey came out a couple of weeks ago and he said he couldn't understand why JB Hi-Fi had a $1.7 billion market capitalisation, so its total market price or its market value was $1.7 billion, yet it only had $265 million of book value. Compared to his business, Harvey Norman, which had $2.8 billion market value and $2 billion of assets, or $2 billion of book value. And he said that that was unjustifiable. Well, in actual fact, it is justified, and it goes to your point about being able to hold and touch these physical assets, because JB Hi-Fi generates, its book value generates a 40% or 45% return, whereas Gerry Harvey's book value, the $2 billion odd of book value, only generates an 11% return. So if I take this cup, for example, and we put some dollars in it, let's put $1 in there, if I've got 20% coming out of that, and I'm happy with a 10% return on my money, well, I could pay $2 for that $1 of book value. But if it's only producing a 5% return and I want 10% on my money, it's only worth 50 cents. It doesn't matter how many dollars of book value I've got, it's not worth that much. And so with online businesses, we've got that precisely that situation. Now, what I've done is I've decided to compare Carsales to automotive holdings. So if you like an online car yard to a physical car yard.
And what do
so
we
you can
learn?
get a sense. You can get a sense of the disparity in the numbers. So for the year to June 2010, Carsales generated a profit of $43.2 million. Okay. Automotive Holdings generated a profit of $60 million. So it was a little bit more. Not a lot more, a little bit more. But here's the thing. In order to produce that $60 million profit, Automotive Holdings needed $1 billion of assets in order to generate that $60 million profit. Carsales only needed $114 million. So it generated a profit that was $16 million less than Automotive Holdings.
It took a hell of a lot more money to do that.
Yeah, that's right. Well, yeah, and Carsales needed a tenth of the capital, of the assets to do it. Now, the great thing about online businesses is they're hugely profitable. Another metric that I can give you for Carsales is for every... So return on... Let's look at the return on asset figure just so you get a sense of it. Automotive Holdings, its return on assets is 6.5%. So a little bit less... actually a little bit more than what you can get in a bank account. Whereas Carsales is 39% return on assets. Okay, looking at another number, for every dollar of sales revenue, Automotive Holdings generates earnings before interest, tax and depreciation, amortisation, or EBITDA, of 3.8 cents per dollar of sales. Whereas Carsales generates 52 cents of EBITDA for every dollar of sales. Now, if you were going to deploy the money in your pocket, you'd want to get the highest possible return, the biggest bang for your buck. And Carsales generates a much bigger bang for your buck than Automotive Holdings. But there's a risk, and this is what I want to talk about a bit tonight. The second thing, I guess, that I want to focus on tonight is what's going to keep that high return going? What is the thing that drives those returns? In order to sustain a high rate of return on equity, a business needs something called a competitive advantage. So there are various types of competitive advantages. Brand is one of them, for example. Reputation could be another. Systems and processes. You know, there are some examples. The most valuable competitive advantage, as an aside, is the ability to be able to charge more than somebody else for the same product, and people keep buying it from you. One of the biggest competitive advantages, in fact, the biggest businesses online, or the biggest internet businesses, the most successful, the ones that seem to make the most money, when you boil them down to what they actually are, they're just lists, aren't they? Think about it. Seek, a list of jobs. Wotif, list of hotels.
Absolutely.
Webjet, a list of flights. And even Google. What's Google? Google is a list of addresses. It's a list of websites. It's just a list.
Of advertisers.
Exactly.
The question is, how do you maintain competitive advantage when what you do is just a list?
That's the big question. So what you've got with all of these businesses, and they're really their only source of competitive advantage, I believe, is something called the network effect. So the network effect is this idea that more people, I'll give you an example, more people go to realestate.com.au to look for a house because more houses are listed. And more real estate agents list their houses that they've got on realestate.com.au because more people are looking for houses there. But it's not permanent.
I was going to say that if you've got somebody else who comes in with an amazing brand,
correct,
an amazing way to structure the list, an amazing way to introduce search engine optimization, all of a sudden you've got a competitor.
That's the big risk with all these things. Now, Carsales.com, a bunch of customers, key customers, 25% of Carsales business has now gone up stumps and started a new rival. Now, my guess is the bottom line is they want to sell cars. So they've got to keep their cars on Carsales while they're assessing the success of this other venture. But if it becomes successful, then that network effect potentially is eroded. So network effect, I think, is one of the weaker competitive advantages, but that's what many of these businesses rely on. So if you're investing in these businesses, beware of those risks. And the last thing that I want to talk about is what their intrinsic values are, so people can get a sense of whether there's any value in the online space at the moment. And when I look at these businesses, Carsales, so people can write these down if they like. I've got an intrinsic value for Carsales of $3.56 to $3.97, so that's significantly lower than the current share price.
Right.
Realestate.com or REA Group, I've got intrinsic value between $8.60 and $8.94. Again, significantly lower than the current share price. So there's no bargains in those two. Well, what about Seek? Seek's trading significantly higher than its value, which I've got at $5.14. And Wotif, again, trading significantly higher than its value of $3.93. So they're great businesses to own. If you can own them and you can maintain that competitive advantage, they're wonderful businesses to own. But those competitive advantages may not be permanent. That's the problem. Someone in a garage, as you rightly point out, could be coming up with this wonderful alternative, and they're not cheap at the moment.
What kind of internet businesses tend to be more successful? We had the days of newspapers where online classifieds funded the newspaper. Now most of those are their own independent entities online.
I think the classifieds, taking the classifieds business, that's been the low-hanging fruit. And I liken what's going on in this space to a blender. It doesn't all blend up straight away. It's not all perfect. So you hit the pulse button and everything blends up and then it settles down. So it all becomes very, very difficult to work out who's going to win. And then some people rise to the top and some businesses fall to the bottom. I think Fairfax is doing a really good job, and this was brought to my attention by one of my clients. Through the Age app that they've built for the iPad, they've got something there that I think is the way forward for all entertainment type businesses. I can imagine a day where you have your iPad or you have whatever it is that your reader is to look at the web, and you read ads and you read it just like a normal newspaper, and you see the classifieds in that newspaper. So the car lists are in the newspaper and you click buy or inquire and it gets sent. You don't have to go to carsales.com to go and buy your car. You don't need to go to these disparate websites to go and do all the things that you want to do.
The newspaper models will be hoping that you're right, I'm sure. Thanks for joining us on the program today.
It's a pleasure. Nice to be back.
Roger Montgomery chatting to us on Switzer.